Good morning, everyone. The topic for today is volatility modeling, and slowly we will move to univariate to multivariate. So there are many things which are very common in literature. If you see the distribution of a series, we assume that they are normally distributed, but uh, we found fat tails in the distributions. So what is the meaning of fat tails? Let me explain. Normally the distribution is like this, but if we go in practical data set, so we found the tails like this, especially on the left hand side. The tails are not thin, tails are actually fat. So these extreme movements, they are very common in some sector like the stock market, currency, commodity. So this is the obvious phenomena. And because of these fat tails, we have to design some special studies which are focusing only on the fat tails. So GARCH is one of them. And we have value at risk concept, expected shortfall. So we have the concept like expected shortfall. So these concepts are focusing only on the tail side of the distribution. So this is one of the phenomena which motivates the researchers to focus not on the normal side rather than focusing on the tail side. GARCH models are one of the basic models which focuses on these fat tails. So this is one of the property of financial assets which motivates the investor to look on not on the normal side, on the extreme movements. So these fat tails are basically representing the extreme. This is extreme positive movement and this is extreme negative movement, which is beyond the normal, because normally we have this region known as acceptance region, and the region, this is rejection region, and a rejection region normally assumed to be very less, hardly 5%. But in financial data, these regions are quite fat. So this is one of the motivation to study the volatility, because all the movement in these regions generate volatility. So this is point number one. Point number two, most of the data, financial data, is not actually normally distributed. 90% of the financial data, especially if they are time series, daily basis or monthly basis, the leptokurtic is very high. So most of the movement are lying near to mean. So they are not following the normal distribution. This is one of the phenomena. Another phenomena which is very, very important, and I need to explain that, that is called volatility pooling or volatility clustering. So what is that? So this is the basic phenomena of volatility. Let's try to understand that. What happens? The emotions have a tendency to carry forward. Like for example, if you are sad today, the probability that you will be sad tomorrow is very high. If you are happy today, the probability that you will be happy tomorrow is very high. Emotions carry forward each other, right? So suppose you are happy today, tomorrow you will be happy, again you will be happy, and you also happy. So happiness persists for some time. Similarly, if you are sad today, you remain sad for some time. This is called clustering of the emotions, emotional clustering. So this concept we apply directly on the stock market data. And we believe that once the market is volatile, this is representing the volatility and this is representing the stable period. This is representing the stable period. Just a moment. So we can say that volatile period are carry forward each other. And if once the volatility comes into the market, it remains there for some time. So this is known as clustering. Similarly, if we have the stable period remains for some time. So this is called persistence of the volatility. So we have both type of movement in the market, clustering of the high volatility and clustering of the stability. So in simple language, once the volatility comes into the market, it remains for some time. Once the stability comes in the market, it will stay for some time. So this is called volatility clustering. Volatility clustering. This concept is leading to a model that if we put a regression model like ET square equal to alpha plus beta ET minus 1 square. Now what we are doing in this model, we are trying to find out whether the previous error term, this is previous error term, ET minus 1 means previous error term, whether the previous error is causing the next day error or not. So if beta is found to be significant, this concept indicates the presence of volatility clustering. So this is called volatility clustering. Similarly, you can go to different legs. This model, let me write one more time. In general, to examine the volatility clustering, we are saying that ET square equal to alpha plus beta 1 ET minus 1 square plus beta 2 ET minus 2 square, like this. So this equation is known as a arch, let's say N model. Arch N model. Arch means auto-regressive conditional heteroscedasticity. So why it is auto-regressive? Because we are trying to run the regression between today, yesterday, and day before yesterday error terms. So these error terms are known as conditional heteroscedasticity. Why conditional? Because we are putting the T. So the T means on a specific day, the error term. So this is indicating the conditional because we are putting the T. So we are not talking about the in general volatility. We are talking about the on a particular day. So ET square, this is conditional. And because we are talking about the error term, so which is not constant. So that's why it is called heteroscedasticity, conditional heteroscedasticity. Heteroscedasticity means the error terms are not equal. That's why we are running this equation. So autoregressive conditional heteroscedasticity say that the error term of any day is influenced by error term of previous day and error term of another past legs, leg 1, leg 2, leg 3, leg 4, like that. And this test is generating one important test that is called GARCH LM test. So in EVUs, before moving to the GARCH model, first of all, we have to ensure that whether the autoregressive model is significant or not. So we are trying to establish the relationship between the error terms, and if the relationship is found to be significant, it means there is a volatility clustering in the series, and this volatility clustering is one of the reasons to go for GARCH models. And this concept is very, very important concept. So I hope you understand it. And another term is called leverage asymmetric effect. Leverage asymmetric effect means if positive information comes, the market react in a different way. If negative information comes, market react in a different way. Like a human being, as a human being, if I ask you, suppose you heard a positive news or suppose you heard a negative news. Can we say your reaction to both the news are same? So think on that, and very soon you realize that normally we underreact to a positive news and normally we overreact to a negative news. So this underreaction towards a positive news and overreaction to a negative news, this difference is called asymmetric effect. So asymmetric effect is very, very also common in volatility in the market. So when a negative news comes, volatility is very high. When negative news comes, volatility is not very high but not very high. So this is called leverage effect. So these are the basic phenomena in the financial time series, which makes this volatility modeling very, very important. And the last point, the volatility is not linear. It is non-linear. Because volatility is not linear, so OLS model will not work here. We cannot use the ordinary least square regression models to capture the non-linear volatility. So we have to apply some advanced models like maximum likelihood estimate model. OLS model will not work in this case because of non-linearity of the volatility. And so this point I already explained you. The error terms, we assume that the error term should like this, but this is not the case. The theory say the error term should be normally distributed with mean zero and constant variance. But whenever we plot the volatility, the actual volatility comes like this. The error terms comes like this. So this is the ideal movement of the error terms, and this is the actual movement of the error terms. And if you see the difference between the two, the difference is very clear. The easiest point which you can identify is that the error variances are not equal. You can see the spread. Sometimes the height is more, sometimes the height is less. So error terms are not equal. This concept is called heteroscedasticity. Heteroscedasticity is the longest word in the dictionary. And so we have already a session on heteroscedasticity. So how to design a model on this heteroscedasticity? So this is the objective of this GARCH model. So GARCH. CH means conditional heteroscedasticity. So what we are going to do in complete volatility modeling, whether we are going to apply DCC model, E-GARCH model, T-GARCH model, in all the GARCH models, all the GARCH family, the key objective is to design a model on this conditional heteroscedasticity. So heteroscedasticity is simply non-equal variance of the error terms, and conditional means we are not talking about the in general, we are talking about a particular day. So T is attached with all error terms. Like you can see that T is attached here. So whenever you attach T here, it becomes conditional. So all the models which we are going to learn are on conditional heteroscedasticity, and which is non-linear in nature. So this is the basic point we need to understand. So I am repeating this again and again because we are going to discuss conditional heteroscedasticity for next many days. Okay. So this expression you may seen many times. This expression is saying that the error term of a model, and all the error terms come from a forecasting model. This is the error term of a forecasting model. The forecasting model may be univariate or a multivariate. So normally I have seen in papers, the researcher apply ARMA 11 model as a forecasting model and save the residuals, and these residuals become the genesis for GARCH model. So if we are using only one series, we will go for ARMA 11 model. Otherwise, you can go for multivariate forecasting models too. So volatility. Now we are using the term volatility. Basically, most of the scholars do not understand the meaning of volatility. They are using the term volatility very frequently. But the problem is that they don't know what is actual meaning of volatility. In some interviews I have seen, so whenever we ask that what do you mean by volatility, we are not getting the right answer, because there are different type of volatility, and somebody knows another volatility, somebody knows other volatility. So volatility is basically the uncertainty or the risk associated with the financial asset, because financial assets are not moving like a constant, like fixed deposit. They are moving in an unexpected way. So the risk and uncertainty associated with the financial asset is called volatility. And if we say that there is a high volatility in the financial asset, it means that the price of that financial asset may go down or may go up, right, in the future. So a high volatility may result into substantial change in the price of a financial asset over a short period of time in either direction. A lower volatility means the price will not change. Lower volatility means that an asset value does not change or fluctuate substantially. Like gold is less volatile. So if you compare gold with the security shares, shares are more volatile, their values are moving by up and down in a short period of time, but we have not seen crashes in the gold. So, but changes in the value at a steady price over a period of time. Okay. So I hope you are having some sense of volatility. So volatility can be defined as a risk and uncertainty associated with a financial asset, so that it can move substantially in a short period of time. Okay. Now the point is that the volatility is one of the attractive topic for research scholars, and there are many scholars are applying different type of model to study and to model this volatility. And not only this, those who are managing the portfolio in the mutual funds or those who are fund managers, so they are analyzing the volatility to a large extent, because managing the volatility is one of the challenge that these fund managers has to deal with. So there are many questions comes related to the volatility. Number one, can volatility be managed? Can we make profit in a volatile period? Can we maximize our profit due to volatility? And if volatility comes, in how many days it will end? What is the average period of volatility? And is volatility seasonal? Is volatility long term or short term? So there are many questions related to volatility which we need to answer. So that's why this topic is very important, because the understanding of volatility will help you to lower down your risk, loss, make profit, large profit, super normal profit in the future from the portfolio. So knowledge of volatility is very important for anybody who is managing the portfolio. Rather, how to take the benefit of this volatility, we need to know. Sometime I will give you one of the strategy. Basically, there are two strategies which are very effective strategies to make risk-less profit. So I will also discuss on that. Now, in time series analysis, when we design a forecasting model for a financial security, the model gives the predicted values of dependent variable, which may or may not be same as actual values of dependent variable. Like if we develop a regression model or multiple regression model, so every forecasting model will compare the actual value and the predicted value. And in most of the cases, the difference between actual value of the dependent variable and the predicted value of the dependent variable are not equal. And this difference is known as the residuals. So we want that these residuals fall in a range and have normal distribution with zero mean and constant variance. But in practical, this is not the case we will get. So we found that the residuals are having unequal variances. Sometimes they fall in a range, sometimes show extraordinary jumps for a short period of time. So this is called the volatility. These residuals, when becomes volatile or showing the extraordinary movements. So like this graph, you can see that there is a extraordinary fall in the prices up and down. So this is basically volatility. And you can assume that this green line is showing you the stability and the red line is showing you the volatility. And the investors are doing actually the volatility rights in the stock market. So yeah, one of the concepts which I already explained to you, that volatility pooling or volatility clustering. Sometimes we found that there's a huge volatility in the stock market, We have seen in Corona times, we have seen this in Russia-Ukraine war recently. And previous to that, we have seen this volatility during demonetization news or during China devaluation news. So there are many, many of us also have seen volatility during the 2008 time when there was a subprime crisis happened. So on an average, this is my experience that in 2 years time period, volatility always comes because investors may, it is very, very difficult for investors to remain stable for a long period of time. So whenever some negative news comes, the volatility come back to the market. Even if when there is a positive sentiment in the market and some event happen like the North Korea king shoot a missile over the Japan, then also it will create tension. It may create tension in the sentiments. As a result, the market may go down. After that, we have seen that there is a election time period. The major elections are US elections. US elections have a strong effect on us. Elections in India in 2024, we are going to face the elections. So that time will also be a volatile period. And it is found that the 6 months before the elections are having the volatility. And every year, budget, the budget day, fiscal policy, the 1 month before, volatility increases in the market. So it is so common to have volatility in the market. You cannot avoid this volatility. And it comes in the cluster. Whenever the market is more volatile, it remains volatile for some period. So this is the basic phenomena of volatility. Like for example, you can say this is a stable period and this is a volatile period. And now there are many questions comes in the mind because all of us want one thing, to increase the wealth. And to increase the wealth, we we save our money, we invest our money in different like fixed deposit, like stock market, like and different markets, gold. So it is very difficult to face these kind of volatility because if you are investing your money in stock market, the problem is that the volatility comes frequently, and how to manage this volatility, that is a big question. Either the long-term investors don't care about this volatility, but a retail investors is heavily influenced by the volatility. During the Corona times, I know that many friends of mine start selling their shares. I say them, don't sell your shares. Rather, you buy your shares. This is a golden time period of buying the shares. Because the market came down by almost 50%, 40% during the time, 12,000 to 7,000. And Warren Buffett and many investors say that whenever the market came down by 30%, this is a golden chance to enter. So all the big investors, they started investing in these stocks, and most of the retail investors, they are selling their stocks. So this is the reason that why the person who have complete understanding on the volatility make money, and the investors who don't know this volatility loses money. So this topic not only creates your research abilities, but also improves your potential to make returns from the market and make you comfortable in the stock market and in any other market where you want to invest your money. The most volatile market, according to me, is the derivative market, even more volatile than the stock market. So if you love volatility, you can also make money from the derivatives. So we will discuss on that also. Okay. So the one simple concept that we want to understand at this time, that volatility always comes in bunches, clusters, right? Okay. Now the types of volatility, because this is the topic which you should understand, because there is a lot of confusion that what is volatility. In literature, we have four type of volatility. So what are these four type of volatility? So try to understand this concept very carefully. The first type of volatility is historical volatility. Historical volatility. So historical volatility is something which we use in the formulas. Like, let me explain you the formula. The total risk. You know that there is a formula called total risk equal to systematic risk plus unsystematic risk. So we know that there are two types of risk: systematic risk and unsystematic risk. And the question is that how to calculate these kind of risk. The total risk of a portfolio or a security is equal to systematic risk of the portfolio and unsystematic risk of the portfolio or a stock. The total risk of the portfolio is measured by the variance of the portfolio, but it is historical. Normally last 1 year. So if you calculate the annualized standard deviation variance, this is representation of the total risk. Systematic risk is equal to beta square sigma m square. Beta is the sensitivity between the portfolio and the market, and sigma square is the variance of the market, and this is the residual. This is the residual. Means total risk minus systematic risk, whatever is left is called unsystematic risk. So we don't calculate unsystematic risk, it is the residual risk. The difference between total minus systematic, whatever is left is called unsystematic. So when you use this formula, we are calculating the risk by variance of the portfolio. If you square root of this is called volatility. Or simply volatility is represented by historical standard deviation. So in books, you have studied this, that volatility is measured by the standard deviation calculated on the historical data of a series. So in simple language, we can say that this kind of volatility is historical in nature. And we have used this volatility in total risk. Even there is a formula. The formula is Black-Scholes model. So if you want to calculate the call price or a put price, so all the call price and the put price is a function of 5 inputs, like a spot price, a strike price, risk-free rate, time to maturity, and the last is volatility. Normally, we are assuming that the asset is not dividend paying. So with this assumption that if the asset is not paying the dividend, we are using the historical volatility to calculate the call price and the put price. So in most of the formulas that we are using in finance, we are using the historical volatility. So the first kind of volatility is actually the historical volatility. Okay. Now after that, after the historical volatility, the second kind of volatility is called implied volatility models. Now this is very, very important because there are many papers which are only on the implied volatility. So what is implied volatility? The second kind of volatility is implied volatility. Implied volatility means the volatility which is going in the market at present. So this is past and this is present. So the current level of volatility in the market is called implied volatility. So implied volatility is simply the volatility which is currently in the market. Now the question is that how we can calculate the implied volatility. So let me tell you the logic of that also. How can we estimate the implied volatility? Basically, we are using the formula that call price or a put price is equal to. So there's a formula for call price and put price using the Black-Scholes model. So we are having S, K, T, R, and sigma. So this is the formula. So we give all the five inputs. We give all the five inputs and calculate the call price or the put price. And now we are going to reverse. We are not calculating the call and put price. Now we are taking the call price and the put price from the market. And this call and put price are basically the out of the money market, out of the call and put. So those who are in finance, they know that there are in the money, out of the money, and at the money. So both call and put prices are basically out of the money. And now we are calculating the sigma. So in previous case, we are calculating the call and put by using these inputs. And now we are in second case, we are calculating the sigma on the basis of these. Now the C and P are basically the one of the input. Like, let me show you a very simple example. If I am saying that Y equal to 2x plus 3z, let's say 3z plus 3a. Now, if I say that if x equal to 2, z is equal to 3, a is equal to 5, can you calculate the value of y? You say yes. So y can be calculated. But if I say if y is equal to 3, x equal to 1, and z equal to 5, can you calculate the value of a? The answer is very simple. Yes, we can. So this is called finding out the value of the dependent variable and calculating the value of one independent variable by reverse. So in this way, we can calculate the implied volatility very easily. And frankly speaking, there are many formulas or softwares which are available in the market. You just put the dependent variable and all the other input, implied volatility can be calculated within 1 minute. So the second kind of volatility which we have to deal with, implied volatility models. And in the stock market, we are having the volatility index, VIX. So this VIX is representing the implied volatility. This is not representing the historical volatility. So in NSE India, National Stock Market, National Stock Exchange, they are maintaining this volatility index, and you can see the volatility index on daily basis. And many technical investors, who are doing the technical analysis, they are taking this volatility index as a proxy of the indication of the future movement of the market. It is believed that whenever the implied volatility increases in the market, it means the market is going to be down. Market is going to move down. Whenever the implied volatility come down, it means that the market is supposed to move upside. So there are many technical indicators on the volatility which guides you that whether you should enter into the market or you should exit from the market. And one very interesting thing which I am going to tell you. So because we are taking the call and put prices like this. So this is out of the money call and this is out of the money put, and this is at the money when the strike price and the spot price are equal. If you plot the implied volatility, on the call side, it moves like this, and the put price is moving like this. So it is found that the implied volatility on the call side is slightly lower, and the implied volatility on the higher side is slightly higher. Basically, this is a smile. This is a smile, and this smile is known as volatility smile. So this smile is known as volatility smile, and it is nothing. It is a plot of implied volatility on any day. And one very interesting thing it is observed that this volatile smile is not symmetric. It is a asymmetric volatile smile. Asymmetric volatile smile. So you can see that on the put side it is higher, and on the call side it is lower. So this is a asymmetric volatility smile, like, and this is the smile which is not a normal smile. That's why somebody say that it is a skewed smile. So that is the concept which is connected with the implied volatility. So we understand. I hope we understand the meaning of historical volatility and the implied volatility. Now the next we are going to discuss is the conditional volatility. So now I'm going to explain what is conditional volatility. The third type of volatility is called conditional volatility. So in conditional volatility, because you have to understand it, because we are going to make models on conditional volatility. So what is that? So conditional volatility say that the y is a dependent variable, and we are making some forecasting equation. So this is the basic forecasting equation. It is ARMA 1-1. So let's assume that this is the basic forecasting equation. This forecasting equation is known as mean equation. This forecasting equation is known as mean equation. Now what we are doing, we are saving the error terms of this equation. So like E1, E2, E3, E4. So these are the error terms of the equation. So these are the error terms which are nothing, these are the difference between actual y and the predicted y. Now, if we make any equation on this error terms, like for example, first equation that we are making is ET square equal to alpha plus beta 1 ET minus 1 square. This is the first equation we can make on residuals. So this equation is known as arch model. Arch model, and this equation is known as variance equation. So you need to remember one more thing. This equation is known as variance equation. So the equation which we make on y dependent variable is known as mean equation, and the equation which we make on residuals is known as variance equation. So in volatility modeling, we always make two models. One is known as mean equation and another is known as variance equation. So I hope you understand what is the difference between mean equation and the variance equation. Okay. So now the first kind of models which we make on the variance equation is autoregressive volatility models. Autoregressive volatility model. So you can see that we write like this. This sigma t square is nothing, you can also represent by et square. Et square equal to beta naught plus et square t minus j. T minus j means et minus 1, et minus 2, et minus t, e minus 3. So this is the basic equation we make on volatility. So let me write in my way. This is simply et square equal to alpha plus beta 1 e t minus 1 square plus beta 2 and beta not beta 2 et minus 1 2 square. So this model is known as arch 1 model. Now we make a small change in this equation. We are making a small change in this equation, that the et minus 1 are the actual error terms, et minus 2 are the actual error term, but this is the error which we are going to forecast. So we want to know, suppose we want to know what will be the volatility for tomorrow. We know the volatility of today, we know the volatility of yesterday, and on the basis of this, now we are going to predict the volatility for tomorrow. So when we are going to predict the volatility for tomorrow, we will write et square as sigma t square. Now, why is sigma t square? Because we are going to predict. And the right hand side will be as same to this. So this sigma t square, because we are going to calculate the volatility for tomorrow. Tomorrow is a fixed rate. So that's why it is known as conditional volatility. So what is conditional volatility? The third volatility which we are going to discuss is conditional volatility. Conditional volatility can be defined as a forecasting volatility on a particular day. Volatility, expected volatility on a particular day. Expected volatility on a particular day. This is known as conditional volatility. Because arch conditional heteroscedasticity, GARCH conditional heteroscedasticity, DCC GARCH conditional heteroscedasticity. So in every model, we are going to use this conditional heteroscedasticity. So what is conditional? Conditional means expected volatility on a particular day, especially tomorrow. So that's why we put sigma t square. This is conditional volatility. This is actual volatility, and actual volatility. So when we are using the actual volatility, we represent E square. And when we calculate predicted, it is sigma t square. So this is the concept of conditional heteroscedasticity in the GARCH models. I hope it is clear now. So the first test which we are going to apply before going to the GARCH model is ArchLM test. So ArchLM test will tell you whether the volatility clustering is there in the model or not. So it is provided by Angel 1982, still very famous. So Angel say that the volatility on a particular day, the error term on a particular day, so it is applicable on the past data. We are not going to predict anything on it. It is simply applied on the past data. So in past data, we apply E square, we write E square. So whenever you say independent variable E square, it means it is applicable on the past data. So we want to know whether the error square on any day is predicted by the previous errors or not. So this test is known as ArchLM test. Is ArchLM test is found to be significant, it means that there is a volatility clustering in the data. So significant ArchLM model represents the presence of significant volatility clustering in the dataset. And this is the reason of moving to the GARCH models. If ArchLM test is not significant, it means there is no volatility clustering. There is no point of moving to the GARCH model. So whenever you are thinking to apply GARCH model, first of all, you have to pass this test of Angel test, ArchLM test. To pass ArchLM test means the ArchLM test should be significant. So first test that we are going to apply is ArchLM test. This kind of result will come in the EViews. There are two types of ArchLM test. First, on the basis of F statistic. Second, on the basis of the number of observations multiplied by the R square. And both should be significant. Both should be significant. So these are the ArchLM test, and these two tests are based on the equation like this. So error terms is regressed with residual square minus 1. It means E t minus 1 is square found to be significant. And if this is found to be significant, this is always significant. After the Arch model, now let's move to the GARCH model. Okay, let's move to the Arch model first, and then we will move to the GARCH model. So now I'm moving to the EViews, taking the data set and going to show you that how we can examine all these things. So opening the EViews 12. And taking this data, financial asset data. Yeah, so you can see that we are having the data set. Suppose go to quick estimate equation. First of all, I'm going to apply on univariate equation d log, and remember that all the variables should be stationary to apply GARCH model. Nifty, C, AR1, MA1. So I am going to apply ARMA 11 model. Okay. So this is the result of ARMA 11 model. And now go to view, go to see the residual graph. And if you see the residual graph, so we can observe that during 2008, the volatility is very high. So it come down, sometimes it moves up, sometimes it's come down, sometimes it's move up. So this is the volatility. So we are having an indication that it may be possible that there is a volatility in the residual terms. So moving back to the model, again go to view. Now you can go for the stability diagnostics or residual diagnostics. So first of all, we are going to apply the GARCH LM test. In residual diagnostics, you can go for heteroscedastic test, and we are going to apply a special test that is called GARCH LM test. How many legs you want to take? Let's say I'm taking the 9 legs. Let's say. So you can see that 1, 2, 3, 4, 5, 6, 7. Okay, up to 4, it is found to be significant. So first of all, we have to find out the appropriate leg. And just one more time. Now I'm taking the leg 4, all significant. So you can see that the F statistic and observed R square, both representing the significant volatility clustering in the error terms. So before moving to the GARCH model, this is my suggestion that first of all, you have to examine the error terms, then move to the GARCH model. Right? First of all, we have to examine the error terms carefully, and then it is better to move to the GARCH model. So this test is showing clearly there is a volatility clustering in the models. Again, let me add some more terms into it. AR2, MA2. So this is another forecasting model. And now you can see that all are significant. So this model is better than previous one. Devin Watson standard is perfectly true. F statistics is also significant. And looking at the residual graph or standardized residual graph, so you can see there's a volatility period, stable period, volatility period, both in the error terms. Yeah, and then you can try for this GARCH LM test. Let's see leg 4, all significant. So which represent that there is a volatility clustering up to the 4 legs. There is a volatility clustering up to 4 legs. Means if on a day there exists significant volatility, it may be possible that its effect go up to 4 days. Similarly, we can try to change some legs into it to find out that how long is the volatility. So you can see that volatility clustering even exists for a 5 days. We are not having any specific rule to find out the volatility. So we have to try by increasing the legs. Yeah, you can see even on the 6th day. Now I'm telling you the research say that on an average, the volatility lies on for 11 days. On an average, the volatility exists for 11 days. So if I take for 11, although I know that in some case it is not significant. So researchers are doing experimentation and found that, so what is the average period of volatility? So on 7th day, now you feel that it is become insignificant. So up to 6 days, it is significant. Up to 7 days, it is insignificant. So we can conclude that in our data set, on an average, the average volatility clustering is for 6 days. There is a significant This is the average. On an average, the volatility clustering exists for 6 days. Significant. So this is one of the conclusions that we can draw before moving to the GARCH model. And also we have to see another thing. Go back and make residual series. Suppose the residual series name is resid1. Okay, no, this is the residual series. So you can plot its square also. So we can go to generate and okay, first of all, let me minimize this. So go to, this is resid01, it is the residual series. Generate ERR equal to resid 01 square. So this is ERR. Now if I plot it, so you will get this kind of plot, which is also used by the researchers to represent the volatility. So these are the, you can see these spikes. Spike number 1, spike number 2, spike number 3, spike number 4, 5. So these are volatile periods. We can identify the volatile periods very easily by this method. And this graph is clearly indicating that the volatility is not homoscedastic. It is heteroscedastic. Similarly, you can go for this residual term. This is the residual term, and just show its histogram and stats. So you can see this is the graph of residual. Mean is almost 0. If you see, the kurtosis is very high, 15.64. It is very obvious in the financial data set, and it is not normally distributed. Number one. Number two, if you examine its tail, so this is one case, and the tail is this very lengthy tail, and because of these outliers, the tail is not showing usual behavior. So we have to identify these cases also, why it is coming so. So this is the tails of the residual only. We are not plotting the Nifty, we are plotting the residual. So there are some problems we are examining in this error terms. So before moving to the GARCH and ARCH models, it is always better to analyze the error terms. So what is the behavior of the error terms? Okay, now after moving just to after explaining the error terms, now we have to understand the GARCH model. So what is GARCH model basically? First of all, Angel gave a model. That model is the sigma t square equal to alpha plus beta e t minus 1 square. So this is the first test provided by the Angel, and this is known as conditional heteroscedasticity. So this is called conditional because we are calculating for a particular day. This is conditional heteroscedasticity. Why it is conditional? Because we are calculating for a particular time period. And what is the meaning of heteroscedasticity? We are predicting for the next day. So we are converting the symbol from E to sigma. And Angel say that any volatility on a next day, on any day, volatility on next day depends upon the volatility on the previous day. And because this is actual, it is represented by E, and it is predicted, it is represented by the sigma. So this was the first model which explained the relationship between the volatility, and it is based on the assumption of cluster, volatility cluster. Now this Angel is having one student called Bowler Serve. So Bowler Serve was the student of Angel. So he said that the conditional volatility on next day is not only predicted by the error term, it is also predicted by the beta 2 t minus 1 square. Now listen. So Bolov sir say that the expected volatility on a day is predicted by the previous residual as well as previous forecasted volatility. This is the predicted volatility on the previous day. This is the predicted volatility on the previous day. And this is the actual volatility on the previous day. So these two terms in total will predict the volatility on the next day. So this term is known as recit term or arch term. So the research say that this is residual term, this is the arch term, and this term is known as GARCH term. So he say that the Boleslav say that I am introducing a new term that is called GARCH term in the series. So now the model is known as GARCH model. So this is the actual GARCH model, genesis of GARCH model, which came after the Angel test. So in general, the volatility on a day is influenced by the residual of the previous day and the expected volatility on the previous day. This model is called GARCH model, and I'm showing you how to apply this, and I will explain this model in detail also in my next session. First of all, let's try to understand the basics of the GARCH. Okay, now in this case, again go to estimate. So you can see that we are having a method going to arch method, auto-regressive, conditional, heteroscedasticity. So a new window will come. This is the mean equation. You can see that this is the forecasting equation I am using. Forecasting equation, mean equation is, and this is the variance equation. So I am going to apply the simple GARCH model with one lag term. Array distribution, normally we go with student T distribution because errors are not having the normal distribution. So it is your choice with any distribution you can take. So most of the scholars don't take care of the distribution, but I suggest student T distribution rather than normal distribution. Okay, after just doing this, go okay. And we will get the result. Yeah. So you can see that the mean equation, this is the mean equation, and this is the variance equation. So just see carefully the variance equation, because now we are going to focus on the variance equation, not the mean equation. In variance equation, we run the equation beta 1 e t minus 1 square plus beta 2 e t minus 1 square This is sigma. So this beta 1 is represented by 0.15, 0.15, and this beta 2 is found to be 0.60. And the alpha value is found to be, so you can see that the alpha value is found to be 0.000168. So basically, this is the long-term volatility, long-term average volatility. This is the effect of the error terms, actual error terms on the predicted volatility. And this is the impact of previous forecasted volatility on the GARCH term, on the predicted volatility. So it is found that the predicted volatility is having more impact, or GARCH term is having the more impact on the expected volatility. So this is all significant. Both the impact are significant. So in this way, we can examine the GARCH model. And so today, I discussed the basic fundamental concepts behind the GARCH model. We will take to a large extent, we will discuss many models on GARCH, but it is my request that you have to understand all the basics before moving to the next session. So I'm stopping my session here. Today I explained you the basic concepts of volatility, requesting you to see once again, because there are many concepts which we are going to repeat again and again. And in this way, we can run the GARCH model. Impact we have to see by this. So